Defined from an accounting equation. He's saying in a balance sheet, you have assets and you have liabilities. Assets are written on the right hand side and liabilities are written on the left hand side. So, anyway, what do you think asset is?
Where everything exists in the business.
The resources that is available in the business as a result of past transaction window event and which you could control by yourself, and this will bring economic benefits in the future. Now, in that case, sometimes we have a problem. Now, I have a vehicle, leased vehicle. This leased vehicle, on whose books I should show that as asset. Now, let's say I'm going to First Finance and then I get a vehicle. First Finance purchased this vehicle from Abdul Ghani.
The leases are same.
Yeah, and I'll go into the discussion in detail just to make them understand something called substance over form. So, in that case, legally, who is the owner of the vehicle?
The party who purchased.
Yeah, who in this example, who is purchasing First Finance? So they are the owners. So that means if our mindset is saying legally the owner is First Finance, so the vehicle should be recorded in the First Finance books. But who is using it? Who is using it? We are using it, not them. So all the benefits, all the enjoyment, all the luxury of the vehicle are with us. Plus, if any insurance, who should do? We should do. If any accident comes, who should repair? We should repair. So accordingly, all the risks both are managed by us, although legal owner is them. This incident or this situation is known as substance over form. Accordingly, again, it is meeting the fundamental definition of asset. Past transactions, currently resources are controlled by whom, and then benefits are being received by whom. So that is asset. So what is liability then? One side of the face is asset. The other side of the face is the liability. The obligation that we need to fulfill as a result of past transaction and which needed to transfer certain economic obligation to other party. And this will happen when? In the future. So this is liability. So assets are divided by two headings, which are current assets and now no more fixed assets. We call it non-current assets. Non-current assets and current assets. And the liability also divided by two. Current liability, and I hope all of you know the meaning of the word current. IAS 1, we will discuss after some time, talks about the categorization or the definition of the term current. In normal mathematical term, 12 months or one accounting cycle. Within that period, if you will revolve or evolve your assets, those assets are current assets. Now sometimes you have let's say lease liability. You need to pay lease liability in the future for next 4 years. After that 1 year you may have to pay within the next 12 months. Then you will show as a current liability. We call it current portion. So now that is assets, liability, and then what is equity?
Honest capital.
Yeah. How can you define from this context now? Now total assets I have. Of that, $7,000 I need to pay to others. Meaning, remaining 3,000 owned by whom? We call it net residual interest. From this business, the owners residual interest. What is left over for them is the 3,000, which is equity. Equity comprised of original capital plus any profits and any drawings that you have taken up. So that is equity. Then income and expense. What is income? 24. On that date, my net assets 1,500. Here my net asset 1,800. Increase. If you make an assumption at this point, there is no additional capital infused by the owners, there is no drawings, or there is no any other movement. The reason for the increase is simply the income, or actually the difference here is profits. So what is revenue or income is an activity that will enhance, that will increase your net asset, except the owner's contribution. When I say owner's contribution, both pumping in money or withdrawing money from the business. Is that clear? So that is income. Expense, opposite of that. The difference between income and expense is what? What do you call it? The golden term. Every one of us in the world always talk about that word, profit, profit, profit. Finder. Wallah khasara. So this is some of the anyway, why I have to discuss all to give the rule of double entry principles. Now what the double entry principle says, if the asset will increase for any transaction, if the asset will increase, you will
Debit.
if it is increase, I will debit. If the asset will decrease, I will credit. Liability, if the liability increase, I should credit.
Reverse.
And in decrease, I will debit. And income, same rule.
Yeah, credit.
If the income increases, credit, income decreases, debit. And expenses, if the expense increase, debit, decrease, credit. Equity, liability, income goes with the same rule. Is that clear now? So that's. Can we also discuss now? There are how many types of ledgers? You see, we use different. We call it nominal ledger. All the ledgers that we are currently using are all nominal ledgers. Sales, purchases, expenses, fixed asset, receivable, payable, cash at bank, like this. Then also we have something called real ledger or personal ledger. Personal ledger are, you just told me now, sub ledger. Now, when you see, what happens is, now it's all connected. Now we studied the day books. Now this total here 1000, let me say 300, 400 and 300. A, B and C. There are 3 customers. Now what is there is also, you would have come across something called control account. You would have come across control account. What happens is, in part of the nominal ledger, I will complete the double entry for this. I will sales credit 1000, receivable, debit 1000. This is my double entry. Done. That's for the bookkeeper. And he will take that to the next level. Whereas the receivable clerk need to follow the individual receivable from the customers. For that purpose, he will maintain 3 different accounts. A, B and C. So each of them 300, 400 and 300. Condition is, whenever you take the total of all this, that should be equal to the final closing balance in your receivable account. Is that clear? So, that is, we will complete the double entry and we will come up with a complete transaction outcome through the ledger. What is the extract we take from the ledger? What do you name it?
Closing balance.
Yeah, where do you put down all this? One key document. Every auditor come and cry for that. You have trial balance, you have trial balance, you have trial balance. In many situations we have come across, this trial balance is never balances. Always like this. I don't know why. So, again, mathematically, no, let me try to erase this. There is a credit purchase of $500. What is the correct double entry? You debit purchases 500, you credit payable 500. This should be the correct entry. But what will happen if I do it this way? Payable I will debit 500 and purchases I credit 500. Mathematically, still the trial balance will agree. Yet, is it correct? No. So, along as an auditor, along with the TB, if he just prepare the financial, then no use of the auditor. He should verify this transaction to confirm those transactions are recorded in the right way. So, suppose if now what will happen in a situation like this? 900 here, 1000 here. So then we have a difference of 100. In order to balance the trial balance, we use one particular account. How do you name it? I will write here 100 and I will make this again 1000. This 100, you name it as suspense account. And then you go on to review and rectify these transactions. Clear?